This program was first broadcast on Canterbury's access media station, Plains FM, and was made with the assistance of New Zealand On Air.
Welcome to your weekly dose of the Accountology Show. I'm your host and chartered accountant, Nicole Haig, with an insatiable curiosity for uncovering accounting ideas to help businesses grow. I have so many nuggets of gold to share. Are you ready to make your good business great? Let's get stuck right in. Hey, it's your host, Nicole Haig, and welcome to another episode of the Accountology Show. In accounting news, the FMA confirms complaint laid over government bond issue. The Financial Markets Authority, FMA, issued guidance in 2017 on conduct covering trading that sets the bank bill benchmark rate or any other interest rate. Reportedly, a complaint had been laid with the FMA by an unknown party alleging market manipulation. At least one complaint related to the pricing of inflation index bonds issued in August 2022, leading to an excess cost to the taxpayer of $33 million. In a statement, the FMA said it generally did not comment on whether it had received complaints and declined to comment on a report that market manipulation may have cost taxpayers millions. However, we can confirm we've received complaints regarding the trading of government bonds in the past 5 years. We cannot comment any further on the matter, it said in a statement. The Treasury's Debt Management Office said that in August 2022, the Treasury was issuing $1.5 billion to $2.5 billion of inflation-indexed bonds maturing in September 2035. At the same time, it was buying back up to $1.5 billion of a 2025 inflation index bond. Inflation index bonds are a type of bond that is designed to protect investors from the effects of inflation. The interest rate is linked to an index such as a consumer price index, the CPI, and is adjusted intermittently to keep pace with inflation. 4 banks were appointed as lead managers for the process: the ANZ Bank, BNZ, UBS Australia, and Westpac New Zealand branch. The complaint is likely to have come from a competitor bank since the Debt Management Office, which is the DMO, had not stopped using any of the 4 banks in the lead management syndicate since. New Zealand DMO's primary function is to oversee the government's borrowing requirements and associated activities, with a goal of managing debt in a way that minimises costs over the long term while keeping risk at an appropriate level. The FMA said it was aware of the proceeding taken by the Australian Securities and Investments Commission and the Australian Prudential Regulatory Authority against ANZ. In a statement to Australian media last month, ANZ said Australian Securities and Investments Commission was investigating its execution of a 2023 issuance of 10-year Treasury bonds by the Australian Office of Financial Management. The Australian reported that ANZ was involved in one Australian Office of Financial Management issuance of Australian $14 billion, equivalent to 15.2 billion New Zealand, in April last year. Watch this space. Are you a business owner struggling with profit, cash flow, or to find balance between work and life? At Nicole Haig & Associates, we want to help business owners just like you reclaim your freedom. Freedom to spend quality time with loved ones, freedom from stress, and freedom from financial burdens. But how do we do it? It's simple. We listen, we understand, and we create bespoke, structured programs tailored to your unique business and personal goals. With the right education, coaching, and expert advice, we'll show you how to increase profits, improve cash flow, and align your business and personal goals. Don't do it alone. Let NH+A be your guide to success. Work smarter, not harder, with our proven accountability methods. Your freedom starts here. Contact us today. In today's episode, we've got a hot topic that many business owners trip over: markups versus margins. Are you confusing the two? In fact, we've got so much to share with you on markup versus margin that we need to spread this over 2 episodes. Today's episode is part 1. Do you price using markup or margin? If you're scratching your head or feeling a bit unsure, you're not alone. The biggest pricing mistake out there is adding a markup on materials and labour and thinking it's your profit margin. Spoiler alert, it's not. Regardless of the size of your operation, if you're selling products or services, you've got to get a handle on selling price and cost price. The principle here is simple. You must price your product to ensure your costs are covered and that everyone involved gets a slice of the profit pie. But here's where it gets tricky. Markups and margins are often used interchangeably, yet they are two very different beasts. Get this wrong, and you might be making far less money than you thought, or, gasp, not making any money at all. The key to avoiding this pitfall is understanding the difference between markup and margin. This confusion is why your profit isn't as high as you expected when the job is done. Whether you're a tradie, a retailer, or a service provider, you need to know these numbers inside and out. It's the difference between a healthy profit margin and a nasty surprise in your bank account. So stay tuned as we dive deeper into the calculations, examples, and common pitfalls of markups and margins. We'll also discuss how to ensure you're pricing correctly to keep your business in the black. So grab your notepad, because this episode is packed with essential insights that could make or break your bottom line. Let's get into it. Are you confusing markups and margins? Here's an important question for you to think about. Do you price for markup or for margin? The biggest mistake I see is adding a markup on materials and labour and presuming that is your profit margin. It's not. Regardless of the size of your operations, all businesses that deal with selling products or services have to grapple with selling price and cost price. Although calculating these numbers can vary in complexity, the underlying principle is the same. You must price your product in a way to ensure that your costs are covered and that everyone involved in the process gets a cut of the profits. Markups and gross margins can sometimes be used interchangeably when they are in fact two very different concepts. There is so much to consider when you price a job, right? Or price a product. The most important question is, am I making a profit? And if so, how much? You would be surprised how many people either think they know this answer and in actual fact have it wrong, or have no idea at all and just hope for the best. The most important and fundamental component in knowing the answer to this question is knowing the difference between markup and margin. So many people, as I've said, use this term interchangeably, thinking it's the same thing. And I'm here to tell you today that it's not. Markup and margin are two separate terms. And if you get it wrong, it could mean you are making far less money than you thought, or you're not making any money at all. Whether you're a tradie, a retailer, or a service provider, you need to listen to this episode. So let's start by understanding the difference between markup and margin using some simple calculations. I hope you've got your pen ready. So, margin. If you were looking at your financial statements, your gross profit margin is the gross profit divided by the sales. So to calculate your margin or gross profit margin or your GP margin, it's all known as the same thing, you subtract the cost price from the sale price. So for example, you sell some materials which cost you $900 and you sell it for $1,100. So the margin is $200. That's your profit margin. That's your sales of $1,100, less costs of $900. Now, to calculate the margin as a percentage, which you might also see commonly referred to in your financial statements from your accountant, is referred to your gross profit margin or your GP percentage. So the formula is margin divided by your sales times 100 to get the percentage. So let's use this example, the same example. $1,100 of sales, $900 cost, and $200 margin, remember? The margin of $200 divided by our sales of $1,100 equals 0.1818. Times that by 100 to get the percentage, and we've got 18.18%. So this means that the materials that you sold had a profit margin of 18.18%. This also means that after you've sold those materials, you had 18% left over from that sale to pay your overheads in the business, which are your fixed costs. Now, markup. So markup, on the other hand, refers to the difference between a product's selling price and its cost price. It's looking at the same transaction, but from a very different perspective. So let's use the same example as before so you can see the difference. So remember, the material has a cost price of $900 and the markup is $200 to achieve a final sale price of $1,100. However, to calculate the markup percentage, the equation is the sales price less the cost price, which equals your margin, divide that by the cost price, times by 100 to get the sales. So in this example, we know the margin's $200. You've got $1,100 in sales, less $900 cost to get your $200 margin. We take $200, divide it by the cost price of $900. That equals 0.222. Times that by 100 to get a percentage, and you've got 22.22%. So our margin is 18.18%, but our markup is 22.22%. So if we compare the margin and markup results in terms of dollars, both the margin and the markup are the same. It's $200. But however, as I said, in terms of the percentage of the margin is 18.88% and the markup is 22.22%. I bet the question going through your head is, why does it matter if the dollar figure is the same, right? Because if you use a percentage for your markup and margin and you use the wrong one, your profit could be substantially different. So again, using the same example, if you used a markup of 18.88% instead of the 22.22%, because you thought this was the same thing as markup and margin, your profit would look like this. Remember, the cost is $900. You put a markup of 18.88% on it. Your sales would be $900 being the cost times 18.88% for your markup. That's $163.62. You add that to the cost price of $900. That gives you a sales price of $1,063.62. And remember, in our first example, the sales price was $1,100. So that is substantially less. And the markup and margin was $200. This will result in the profit margin being $163, not $200. So you can see why it's so important. If you're using the wrong margin or markup, your sales price could be less, which results in your profit margin being less. Most businesses confuse the markup percentage and the margin percentage, which is disastrous when running a profitable business. So here's a wee tip to help you remember which one is what. The basis for the margin percentage is revenue or your income or turnover sales, whatever you like to call it, whilst the basis for your markup percentage is cost. So margin percentage is revenue, markup is cost. The key takeaway here is that any business confusing their profit margin, so your gross profit percentage, with their markup percentage when pricing a job may find itself in the red once all costs have come through. The confusion is why your profit isn't as high as you expected when you complete the job. Okay, so let's look at another example. Let's say you're a builder. You price a job and the labour and material cost is $10,000. You add a 30% markup and the quoted price to the customer is $1,300. What do you think the gross profit margin percentage is on the job? It's 23%. If you answered 30%, that is the markup. Gross profit margin is calculated by your gross profit margin divided by your sales times 100, just to reiterate again. Remember, you can calculate your gross profit margin by taking your sales and subtracting the costs. So calculating the gross profit margin using the above example, it would be $3,000 divided by $1,300 times 100, which equals 23%. That's how you get a gross profit margin of 23%. Now, if you thought that 30% was the markup of profit, then you're in for a nasty surprise in your bank account when you're using the wrong percentage. You need to make sure you're pricing for gross profit margin and not markup. If you want to know more about this, we've actually got a video on our website under the blog Markup versus Margin. Go and watch this video to learn more about markups and margins. So how much should your margin and markup be? So let's break it down a bit further. Your margin is what's left over to cover your overheads after you've paid for expenses directly related to the product or service you're selling and received any revenue from that product or service. Overheads are the cost of running your business regardless of your overheads. In other words, you incur these costs regardless of whether you manufacture that product you sell, purchase the products to sell, or even if offering a service, having the team engaged to complete the work or the project. So this includes things such as business expenses like company insurance that do not relate directly to the job. You might have an office or yard expenses, leases, stationery, power, phone, security, furniture, etc. All staff time where they're not able to charge directly to a job, so office staff or admin staff, directors' fees, board members, etc. Pricing jobs either internally or externally that you do not win. Memberships and subscriptions, plant, vehicle, equipment, including maintenance, bank fees, tax and interest, your professional services fees, accountancy and legal, etc. So you add them up and then you start reverse engineering. So let's say your total overheads are $100,000 for the year. Now you need to add in your desired profit. So let's say that's $200,000. This is the money that makes the stress of being in business worthwhile. It's also the money you might use to grow your business or reinvest, for instance. So if we've got a gross profit margin of $200,000, we've got overheads of $100,000. If we go 200 less 100, being your overheads, that gives a net profit of $100,000. We'll talk again the difference between gross margin and gross profit and net profit in a little bit later in the episode. Okay, so working backwards, $100,000 profit plus $100,000 overheads means $200,000 per year is the total margin you would need to achieve. Now, knowing that, you need to ask yourself, how many jobs do you need to win to gain that margin? And how many do you price a year at the moment? And then ask yourself, what is your conversion rate? So what are your jobs priced versus the jobs that you've won? If the average job you win is $250,000 and you win 4 of these each year, then that is $1 million turnover or revenue or sales, whatever you'd like to refer to it as. To meet the margin requirements, you would need around a 20% margin applied to all of the jobs you price to cover it. So what's the outcome if you make less than a 20% margin in this situation? You need more sales. And to do that, you need to increase your conversion rate or price more jobs, or maybe both. But just remember, if you are pricing more jobs, then your cost of overheads might go up too. You need to try this exercise on your own business. Then you can try the same principle on each of the individual products that you sell. So do it at a micro level. It's also a jolly good reason why margin should be calculated first prior to deciding what percentage you apply for your jobs, and why choosing to cut your margin to win work is a false economy. So after hearing this, what's a good margin to apply for jobs in your business? There's another mistake I see almost all businesses with under $5 million turnover making, and it's costing them hundreds of hours and large chunks of profit every year. What is it? They treat their business like a job. More specifically, they look at the profit they're making in the business and compare it to the salary they could earn in a job. If they're earning close to it or more than they could in a job, it's happy days. But that's a mistake, and here's why. Let's say you're making a 10 to 15% gross margin. At $1 million per year, that's $100,000 to $150,000 gross. Then you take out your overheads, your interest, your tax, expenses, etc. And you might be left with $60,000 or $100,000 net profit per year. That's your bottom line. If you're turning over $3 million plus, maybe you're keeping towards $150,000 to $200,000 net profit, if you're lucky. That's a decent income if you were earning it from a job. But your business is not a job. Remember, you've got no annual leave, no sick pay, no overtime, no retirement fund. And then consider the sacrifice that goes into running a business. That's the 60 plus hours per week, the risk of hiring staff, buying materials, signing fixed price contracts, the evenings and weekends buried in paperwork, the marketing and sales work, the years of working without a holiday or a vacation. And suddenly that decent income starts to look pretty woeful, especially if you work it out on an hourly rate, which could quite likely be below minimum wage. So what's the answer? Should you pick up shop and start flicking through Seek for a job? Well, I wouldn't. Not if you want a top 1% income and the freedom to enjoy it. Here's what you should do instead. You need to get your margins up. So if you're a builder, for instance, this should be around 20%. If you can reliably keep 20 to 25% of your turnover as profit, things are looking more rosy. For other industries, to find out what your average margin should be, there are benchmarking surveys or industry contacts that you can make, or your accountant will be able to answer some of those questions on where your average market margin should be set. At $1 million, that should earn you $200,000 to $250,000 gross. At $3 million, you should be keeping $600,000 plus. That's enough to earn you a top 1 to 5% income in the Western world. But also, you need to pry yourself away from the day-to-day working in your business and not on it. It's no good being the richest person in the street if you're working 24/7 and you don't get to enjoy it. But if you could earn that kind of money while enjoying your family and friends, having weekends off and holidays, etc., now that feels like success. Time, mind, and financial freedom. If you can do both those things, a business is miles better than any job. Okay, so let's go back to looking at gross margin versus net margin. Okay, it's important to understand the difference between gross and net margins. Put simply, your gross margin is the percentage of profit in your revenue after deducting the cost of sales, which are your variable costs, which we've discussed. Your net margin is the percentage of the actual profit of your business after all expenses are deducted. That includes your overheads and your fixed costs. If you don't have a net margin that is above the minimum benchmark, you have a job, not a business. So it's important to understand what your industry benchmark is. You're simply setting yourself up for failure because without a healthy net margin, you don't have the cash flow to keep paying for the things that keep your doors open. Basically, net margin is building the home, paying all your expenses, including payroll, marketing, rent, and your own salary, and still have cash left over. That's why it's important to include your own salary within your fixed expenses, because if you're taking your own payment out of your net profit, it's not a net profit. The important numbers here are your net margin. It's exciting to see the dollar figures, but the real proof of success or lack thereof is your net margin percentage. A client said to me recently that her aha moment came when she realized the importance of percentages over dollar amounts. She recognized that those percentages and making them increase are what proves that you're running a successful business. As I mentioned before, your markup and margin dollar figures look exactly the same, but the percentages are different. And it's no point having a large margin if the percentage works out to be very minimal, like 5%, 10%. Wow, we've covered a lot today. I hope you're feeling more confident about distinguishing between the markups and margins. Let's wind things down with a quick recap and some actionable takeaways. First of all, remember that markup and margin are not the same. Your markup is the difference between your cost price and selling price, expressed as a percentage of the cost price. Margin, however, is your profit, expressed as a percentage of the selling price. Mixing these up can lead to serious profit miscalculations and leave you scratching your head when the numbers don't add up, and potentially leaving your bank account looking very sad. Here's a key point. Always calculate your margin to ensure you're covering your overheads and achieving your desired profit. If you set your prices based upon markup alone, you might end up with a lower profit margin than you anticipated. This is especially crucial when planning for long-term sustainability and growth. And let's not forget the importance of knowing your industry's benchmarks. Whether you're aiming for a 20% margin in the construction industry or another figure in a different sector, these benchmarks can guide your pricing strategy and keep you competitive. So, until next time, keep crushing those numbers and happy selling. And as Harper Lee, the American novelist and author of To Kill a Mockingbird, said, many receive advice, only the wise profit from it. 3 action points for you today. Now, what should you do next? Review your current pricing. Take a closer look at how you're setting your prices. Are you using markup, margin, or a mixture of both? Make sure you understand the differences and how they impact your bottom line. The second is calculate your overheads and desired profit. Add up your annual overheads and desired profit to determine the total margin you need. This helps you set realistic pricing that ensures profitability. And educate your team. If you have a team involved in pricing, make sure they're on the same page. Misunderstandings about markup and margin can lead to inconsistent pricing and missed profit targets. And if there's one thing you should take away from this conversation today, one key aha moment, it should be that markup and margin are fundamentally different, and confusing the two can significantly impact your profitability. The crucial realization is that markup is based upon your cost price, while margin is based upon your selling price. This difference means that using the wrong percentage for your pricing strategy could result in lower profits than expected or even financial losses. Grasping this distinction empowers you to set prices more accurately, ensuring that your business covers all costs and achieves the desired profit. Thanks for joining us on the Accountology Show. If you have enjoyed today's show, you're in luck because we'll be back next week. You'll find past episodes at plainsfm.org.nz and subscribe on Apple Podcasts or Spotify to never miss an episode. We would love it if you would leave a 5-star review and tell a friend or business owner who would benefit from hearing our show. We also love hearing from you, so reach out with any comments or a topic you'd like covered, and even suggestions for whom we should get in the studio next for an interview. You can find us on Facebook, Instagram, LinkedIn, and TikTok. Our handle is NH Plus Associates, that's NHPLUS Associates, or email me, nicole@nh-a.co.nz. But most importantly, thank you for taking the time to listen to the show. Until next time, keep building that business into the empire it absolutely deserves to be.